Buybacks, another theme this year. Buybacks, already on track to smash records in 2019. Janet Johnston of TrimTab's with us now. She's got a way to play buybacks using exchange-traded funds. And, of course, we're at records still. Buybacks still getting record inflows here. Janet, how does TrimTab's set up an ETF with buybacks in it?
Well, we think they're good buybacks and bad buybacks. So we like the companies that have organic growth. So they have free cash flow growth, and we also look at their balance sheets to see how leveraged they are, if they're improving or not. And those are the buybacks that tend to deliver alpha. So we do have a fund, TTAC, that does deliver alpha over the major market.
So this is very interesting. You're not just going out and buying companies that are, for example, reducing their share count.
Right.
The most, which would be, I call the buyback monsters, the companies that do 4 or 5% reductions. You actually have a sort of a rules-based method. Growing free cash flow, strong balance sheet, and then you factor in share count reduction. And you've got, I see here, the top 10 are about 14%. It's a pretty diverse group, but you've got Zoetis, Illumina, MSCI, Decker's Outdoor that meet this criteria.
We're an all-cap fund. We're equal weighted. We have 100 names. We think of ourselves in the high quality space. We're basically looking at profitability, organic growth, strong balance sheets with a little bit of share reduction. As active managers, we're also looking for modes.
You think that outperforms. So you do have a competitor out there, the PKW, and they've been around for a while. They basically go out and buy shares of companies that are actively trying to reduce their share count. So this has been around for a while. They have Citigroup, Cisco, Oracle, Apple. They have 5% of them. All of these companies have been reducing their share count aggressively for many, many years. That seems a more pure play on the buybacks. Is it your contention that doing it your way, throwing in buyback reduction along with growing free cash flow and strong balance sheet, that does better than just buying this?
I think that not all buybacks lead to riches. And also, I could be wrong, but I think with PKW, they're looking at trailing 12-month. We look at actual share reduction, because we don't really care what a company says or what they've done in the past. We look at what they're doing in real time.
Yeah, their methodology is they repurchase the companies that they own at least 5% of their shares in the previous 12 months. So it was announced. They did actually do it. But your point is that your methodology might produce a superior alpha.
We look at what they're doing now, not what they did yesterday.
I actually think you have a chance to have a new kind of category in investing, which I like. I read an article in CNBC over the weekend about where has value investing gone. Yeah. And it's obviously because there's so much attention to growth. But these are quality companies.
These are high quality.
When you go back at original, Berkshire Hathaway's definition of that, it was quality companies that were just trading at a low multiple. Now, you're not factoring multiple, but they're all the other things that make them quality companies, and then you could add some growth into that. So maybe this can be the new kind of value.
Our companies tend to have organic growth. If you look at our portfolio, we're all cap. We're right in the middle in terms of companies that are categorized as value or growth. Right. But they have organic growth. I personally, in this environment where, is it Goldilocks or crisis, headline crisis, I'm a big fan of moats, so we're also looking for other protective layers to add. So you're right, it's a high quality
And Nick, how do you feel about, you've written about buybacks before. I mean, all things being equal, if all other things on an income statement being the same, a 5% reduction in the share count outstanding does improve your earnings by 5%. So there is something to this idea.
There absolutely is, and more than anything, it shows respect for the shareholder. A buyback shows the company's just not going to waste capital on M&A or a bad investment. They really value shareholder capital, and they will hand it back when they can't use it. We
got to run, but do you want to pay the same multiple for a company just buying back their stock as you do for, say, real growth? I mean, real organic growth? Nick? Janet?
We will look at other fundamentals, but as all of you, they've been talking a lot in the news, value is underperformed not just for years, but for a long time period. Yeah. And it depends on how you define it.
Yeah. So I would pay a higher multiple for growth over just companies buying back stock. That just makes sense to me as a growth guy overall.